Hello, everyone. I'm Roger Conrad, editor and publisher of the REIT Sheet. And thank you for joining me with this members-only presentation, Beating Inflation with Top Quality REITs. I hope by now everyone has had an opportunity to look over the current issue of the REIT Sheet. I realize there's a lot there, including coverage of more than 90 different real estate investment trusts in our database. But I will be focusing on many of the key themes and companies here as well, so they kind of do go hand in glove. My first slide concerns the agenda for today's briefing. I'm going to start with a quick look at the macro and what it means for REIT investing this year. And it has changed a bit from when I gave the last version of this presentation back in September. One thing that hasn't changed is our basic approach of buying top quality REITs across a range of sectors, when and only when they trade at good entry points, and selling only if and when businesses weaken on the inside or if share prices are flying too close to the sun. But for the first time really in the last 40 years, inflation is again a critical factor that investors must take into account with pretty much every decision we make. And that goes double for anyone living off the income from their investments. REITs fortunately give us multiple avenues to not only keep up with, but also actually benefit from an environment of higher inflation. Certainly not every REIT will do this, but many will provide the sustainable dividend growth needed to beat inflation. And identifying them when they trade at good entry points is, in fact, the critical task for the REIT Sheet. After the macro discussion, I'm going to delve a bit into the individual REIT sectors and where they currently stand. Again, building on the themes highlighted in the REIT Sheet issue. I'll highlight my recommendations, the real estate investment trusts that are most ripe for purchase, and I'll conclude the briefing by answering questions posed to me by members recently. So let's get started. My first graph is literally the long view for REITs. It tracks the Bloomberg U.S. REIT Index of 174 different real estate investment trusts. So it's pretty comprehensive at this point. Unfortunately, Bloomberg has said it's discontinuing this as a benchmark. But as this graph shows, it's still possible to get index values. And it does give a very good big picture. The graph starts in 1994. Which is actually a few years after I started tracking REITs. But for all practical purposes, it does more or less track the period from where REITs went from being a minor niche investment to actually the mainstream as they are today. A picture is worth 1,000 words, so I won't spend much more time on this slide except to make a couple of key points. The first is the generally upward trajectory of this index over the better part of 3 decades. You'd be right to say the broad stock market was up over that time as well, which means that virtually all sectors enjoyed a nice tailwind. But rising prices are also the result of the REITs themselves becoming more valuable as businesses, largely the result of asset expansion. Successful REITs have actually been able to grow faster as they've grown larger by utilizing the huge advantages of scale economics in property ownership. Size brings greatly enhanced ability to overcome business setbacks, such as the bankruptcy of a major tenant. It includes much improved access to low-cost capital, and several REITs have demonstrated the ability to sell low-interest rate green bonds as well, which have thus far held up well to inflation and interest rate pressures, even as the bond market as a whole is headed for its worst quarter ever. And size also increases REITs' power in procurement and hiring, which reduces costs and keeps property returns robust. The other point I'll make about this graph is there have been several big drops along the way to greatness, and at least 2 of them were no doubt of enough magnitude to shake the faith of most REIT investors, including professionals paid to analyze their results and strategies. The hit the sector took in the late 1990s may not look like much compared to what happened in early 2020, or especially from late 2007 through early 2009. But it was no less damaging to investors' psyche, as it basically coincided with the historic run-up in technology stocks, and a then quite popular investment theme that income investors were actually better off avoiding dividend-paying stocks and instead buying growth mutual funds with the idea of selling a piece of the ever-growing pie when cash was needed. That strategy, of course, proved disastrous when big tech wrecked, but it's interesting to compare the Wall Street consensus of those times with what's happened the past few years. For example, the massive current technology stock weighting in the S&P 500 and the general underperformance of, quote, value and dividend-paying stocks like the REITs. The aftermath of the late 1990s dip was a REITs rally that lasted nearly 8 years, a good chunk of which occurred mid-decade, when the Federal Reserve was actually raising the Fed funds rate from 1% to over 5%. That's pretty solid proof there is no lockstep relationship between REIT returns and changing in benchmark interest rates, and that's a very important point to always keep in mind. Pretty solid proof, again, there is no lockstep relationship between REIT returns and changes in benchmark interest rates. The other lesson from the dips, however, is that REITs do follow prospects for economic growth. The biggest drops in the index coincided with major sell-offs in the broad stock market due to economic concerns. That again includes the relatively short early 2020 sell-off, but especially the 2007-2009 recession and financial crisis. Bottom line is best-in-class REITs can and will beat inflation, but when it comes to recessions, they behave more or less like other stocks. The more heavily indexed and therefore ETF'd the REIT, the more volatile it's likely to be when there are big sell-offs. Should we be preparing for a big sell-off now? Let's take a look at my next slide, which is a decidedly more short-term view of the same Bloomberg index, basically from September of last year to this week. This period more or less coincides with the gradual realization in investment markets that inflation is not going away so easily this time. And it, of course, includes the reaction to Russia's invasion of Ukraine and the unprecedented resulting sanctions against that country by most of the world's largest economic powers. Takeaway one here is, after all that, this REIT index is now trading pretty much where it was back in September. That doesn't mean every REIT's performance was flat, far from it, but it does mean that after a rising tide raised all boats performance in 2021, the REIT sector has again become a place where wise selection is critical. That's how things were in 2020, and if this year winds up remaining similar to that one, REIT ETFs are going to be a pretty poor place to invest. Again, individual REITs will shine, but the only way we're going to really put them to work for us is by looking for them individually, not buying the average. So that's the technical picture for the REIT sector right now. Now let's take a look at the primary drivers of REIT returns this year on my next slide. First, as was the case for most of 2021, most REIT sectors are still seeing positive business momentum. That's strongly confirmed by my comments for each of the 90 REITs in our databank coverage universe in the REIT sheet. Not just with Q4 results that show rising occupancy, rents, collections, and asset growth, but also with robust management guidance for the rest of 2022. And both of those factors mean dividend risk is also still falling. Not for every REIT, but it means dividend increases are once again the rule rather than the exception as they were in 2020. The progress I'm seeing at REIT sheet recommendations incidentally makes me more confident holding them despite some recession risk, even as the Federal Reserve's attempts to thread the needle between controlling inflation and not wrecking the economy appear to be as fraught as many take their ultimate success for granted. So long as the underlying business remains financially strong and growing, recovery in the stock market is only a matter of time. Conversely, REITs that weaken on the inside always need to be sold. That's why we pay so much attention to individual companies' operating and financial results, though overall, as I've said, the news remains quite good on this primary driver of REIT returns. The second key driver is sector mergers and acquisitions, which have accelerated in the early part of 2022. As always, most of that activity has been at the individual property level, with several REITs making major purchases from private capital entities. But we're also seeing whole companies acquired, most recently Preferred Apartment Communities, which received an all-cash takeover offer from private capital firm Blackstone that's more than 60% above its pre-deal trading range. Over the past year or so, preferred apartment has made itself more attractive to suitors by essentially selling off everything except multifamily residential properties. That's a strategy other REITs are following, and I doubt we've seen the last deal in this regard. Though the apartment sector is again quite pricey, with most sector REITs actually trading well above my highest recommended entry points. Anyway, increasing M&A is always a good sign for any sector, even if the REITs you own don't actually receive offers. You're still going to capture some appreciation, and there's nothing like a hard offer for similar assets to draw a line under the value of REITs you do own. As I said, popular apartment REITs are expensive again. In fact, both Avalon Bay and Mid-American apartment communities on our recommended list are now effectively holds for that reason, pending more dividend increases or meaningful dips in share prices. And the same overvaluation is again true of most high market capitalization REITs, in large part because they're the ones in the indexes that ETFs are set up to follow. High prices are the single biggest reason some REITs in our coverage universe rate sells now, as well as why so many rate holds. So long as they stay strong inside, I expect many to be buys again when the momentum driving them higher inevitably runs out or reverses. But your relative success investing in sector favorites is always going to depend heavily on when you entered the position. And as we've seen over and over again in the past few years alone, it never makes sense to rush in. The other major sector headwind, at least for some REITs, is inflation. Property values and rents rise with inflation, so the real question is always going to be how management handles the cost side. One issue is new construction, where developers face the highest commodity prices in some years, as well as supply chain disruption, and in many cases, surging labor costs. And some sectors face staffing challenges as well, particularly conventional senior housing. Again, what's important here is how management handles the cost pressures. And at this point, that's still very much a work in progress, which is again why we have to pay attention to earnings and guidance at individual REITs in the coming months. The REIT Sheet Databank comments highlight the latest on Q4 and guidance, and I strongly encourage everyone to check out how REITs they own are stacking up. So that's basically the macro picture. Rising inflation, increased risk of a recession if the Fed can't thread the needle on monetary policy, potentially unsustainably high valuations for ETF and index favorites, but also still very strong business conditions coming out of the pandemic, stepped up M&A, and REIT bargains available if you look for them. Now let's take it down to the various REIT sectors and how they're faring. My first slide in this section of the briefing is actually 4 pictures in one, and it's an update of a slide that I presented in previous briefings. Starting with the upper left is a graph tracing property values by broad sectors from December 2000 up until late last year. The bright red line is office properties, the biggest winner over that time in terms of rising values. The orange line is industrial warehouse. The black and dark gray lines are subcategories of office properties, and the gray on the bottom is retail properties, the clear laggard of the past 20 years or so. As the graph shows, all property took a hit during the 2007 to 2009 recession and financial crisis, from which it took several years to recover. They've generally trended up ever since, with the exception of pandemic-stricken 2020. And in the past year and a half or so, property values have fully recovered their pandemic fall and then some, the exception being office, the red line. Moving to the upper right graph, the blue line shows the trend in vacancy rates for residential property owners, measured as a blend of markets across the country. The clear takeaway is occupancy is seeing a strong recovery, and that's definitely confirmed in the results of the biggest apartment REITs, with the most dramatic turnaround in recent months coming in urban markets. In fact, the only major market most REITs show hasn't started producing positive year-over-year comparisons is Northern California, which had become so expensive before the pandemic that it was arguably due for a substantial correction anyway. So residential is booming. In contrast, retail is still in recovery phase. There's a lot of information in this picture, which is in the bottom left of the slide, But the most important thing is the big spike in vacancy rates we saw in 2020 has now run its course, which is also confirmed by the results of individual retail REITs in the coverage universe. Especially bullish are the trends in grocery-anchored shopping centers, as I pointed out in the REIT sheet discussion. And I'm bullish on many of the names there, including Kimco Realty. The fourth graph is office vacancy rates dating from 1990. The fact that most office property leases are multi-year, in some cases multi-decade, really saved the bacon for office REITs the past couple years. Mainly, tenants locked into leases for the most part kept paying, even though no one was working in those spaces. And now some office property REITs like SL Green are reporting strong gains from retail, residential, and other customers attached to their office buildings, a clear sign that at least some tenants are starting to return to the office. The latest coronavirus strain remains a threat to stall this momentum yet again, but I think the pressure on office REITs' revenue and net operating income is likely to lessen this year, again, particularly for those REITs who also rent to retail and other cyclical type tenants. The real challenge, though, is going to be what happens as leases expire. Mainly, tenants have been learning to accommodate unprecedented home office work for 2 years now. And since rent is a major expense, many will likely look at ways to trim the cost by using less space. Since leases tend to be staggered, the largest and best positioned REITs should be able to adjust. And in fact, more than a few like WP Carey are adjusting their portfolios in favor of industrial and away from office. But I think office REITs as a group are in for a long-term period of adjustment. And so far the jury is out on what shape that will take, meaning this is a sector where caution is strongly advised. So a lot on that slide to peruse at our leisure, but let's move on to the next slide, more or less summing up where each of these sectors stand in the current environment. The column on the left titled, quote, Recovery Plus Momentum highlights sectors where the vast majority of REITs have turned the corner from 2020 and in fact are now seeing record results. The other lists sectors that still haven't climbed that hill and in fact may still be in trouble, particularly if the economy does slow down. This doesn't mean that every industrial REIT is a buy, for example, or every hospitality REIT is a sell. In fact, there are standouts even in categories like mortgage financial REITs that I consider to be quite problematic. And most telecom and data REITs, a great business, are now sells to what I consider to be unsustainably high valuations. But this category analysis does very much inform my assessment of overall risk, and it bears saying that it takes an exceptional REIT to really swim against the tide in a sector and produce good investment returns. If you were with me for my previous REIT sheet webcast presentation, you'll notice that one of the REIT sectors has switched sides. That's urban residential, a laggard in the recovery up until recently, and which I've now lumped into all U.S. residential. Other than that, most of these are pretty much the same. Life science and medical specialty are actually considered office in a broader context, but they're a unique niche that's growing rapidly as healthcare research efforts ramp up with, quote, campus-type environments, increasingly preferred by tenants for infrastructure and collaborative purposes. As such, life science is generally immune from the pressures facing other office landlords. So is what I call, quote, unconventional senior living, to what increasingly appears to be severe reputational damage at conventional retirement facilities caused by the pandemic. Of course, one of the key drivers for all these REITs returns going forward is going to be how well they handle inflation pressures on costs. Other than labor cost pressures on senior housing REITs like Welltower, we really didn't see a whole lot of inflation impact on Q4 results. But if you look at this next graph, wildcard inflation is back, it's easy to envision costs becoming a major differentiator of REIT returns going forward. As this 5-year graph shows rolling percentage changes for the Consumer Price Index, excluding food and energy. Those are, of course, hard for anyone in real life to exclude, food and energy, for example, from daily budgets. But I wanted to present this graph to show that inflation has really taken hold. It's not just gasoline or food prices. So what's inflation's impact on REITs going to look like? Well, let's look at the next slide. First off, as I've said, inflation has historically been very bullish for hard assets, which includes physical property. There are obviously multiple nuances here. If, for example, interest rates rise enough in response to inflation, the market for purchasing property could dry up, which at least in the near term would actually depress affected property values. But generally speaking, the value of land and buildings tends to rise when inflation does. Second, and more important for REITs' dividends and dividend growth, inflation pushes up rents. That will come automatically for those with rent escalators built into leases, but it will eventually come to all as leases are renewed. Debt is a big part of finance for any capital-intensive business, which property ownership and development most certainly is. The biggest risk in an inflationary environment is borrowing costs rise faster than property revenue. If a REIT relies primarily on fixed-rate debt to fund development and acquisitions, then its costs won't rise. If it relies on credit lines instead, however, then costs will rise. For most of the past 20 years or so, borrowing rates have been at multi-generational lows, including for property development. Now that they're rising again, controlling the cost of debt is again a critical task for management, including when refinancing is needed. So is controlling the cost of new construction, no matter how lucrative the project appears to be. Bottom line is the REITs that succeed in turning inflation to their benefit will be able to ramp up dividend growth in a way they haven't been able to for some years. That in turn should earn them a premium valuation in the stock market, even if stocks overall decline. They're what we want to own now from a good entry point. In contrast, it should become apparent over the next several quarters what REITs are not prepared for inflation, and chances are we're going to want to move on from them. Again, this is very much a work in progress, but the REIT sheet will be keeping you up to date, both on the macro and the individual company level. Now let's take a closer look at these individual REIT sectors. I won't spend a lot of time on this slide, Sector Outlook 2022. It's more or less the main topic of discussion in my analysis of REIT sectors in the current issue of the REIT sheet. Simply, the best risk-reward right now in the REIT market is with best-in-class grocery-anchored shopping malls, life science, specialty finance, such as the three I highlight in the REIT sheet, non-conventional seniors REITs like equity lifestyle properties that provide more options for living, including resorts, selected industrial properties, mainly those that haven't yet been bid to the sky, targeted Canadian REITs, and likely targets for mergers and acquisitions, one example being Iron Mountain in the data center space as I identified in the REIT sheet. The worst risk-reward by sector is with REIT icons. Again, that's entirely because of sky-high valuations that appear to be the result of ETF-spurred momentum that's simply not sustainable. To that list are also most mortgage or financial REITs, which face a period of growing uncertainty with both rising interest rates and credit risk, even as they've yet to recover fully from the pandemic crash. Conventional retirement communities' occupancy remains well below pre-pandemic levels, and indications are the improvement we saw last year has stalled, even as costs like staffing are on the rise. Most data center REITs are quite expensive on a valuation basis, limiting future upside. And as I noted above, the office sector faces extreme long-term uncertainty about just how much space tenants will rent. Finally, I generally advise avoiding REITs that are in a business that doesn't have a long-term track record of paying dividends. REITs are a popular corporate structure because they enable companies to reduce taxes. But paying out most income in dividends means less accumulation of capital for a rainy day. And that means if the revenue slows, the dividend will surely go. I'm not saying we should avoid all REIT IPOs, far from it. But if the REIT in question is based on a business model without a track record of paying dividends, I want to see how it does that for a while before jumping in. A good example would be cannabis-related REITs, of which I've just added one called Innovative Industrial Properties to our database coverage. So thank you for the reader who recommended that one as well. I've been a skeptic of corporations' ability to earn reliable rents in a business that relies on growing, processing, and selling a product that Americans have been growing themselves to feed a robust market on an extra legal basis. But innovative industrial has now paid a dividend since July 2017, so I'm willing to include it in coverage. I'm going to go through the next 4 sector-related slides fairly quickly. They all trace the last 3 years of price action. First is a price graph of the Bloomberg REIT Industrial Warehouse Index. This group reached a new all-time high at the end of 2021, downtrended through late February, and has since rallied. The dip has given us some opportunities to add shares of REITs like Dream Industrial, Stag Industrial, and WP Carey, which, as I've said, now has more than half its portfolio in industrial properties. Best-in-class Prologis is out of reach in terms of valuation, but this is a group where business fundamentals continue to move in a positive direction as reshoring industrial operations to the U.S. picks up steam and e-commerce lifts warehousing. The next slide is of the S&P Residential REITs Index, which is weighted towards the biggest apartment owners, but also features smaller operators. The trajectory of the graph pretty much follows that of other REIT sectors as well as the broad Bloomberg index I highlighted earlier on. At the worst of the pandemic in 2020, residential properties looked like they were going to take a big hit to underlying businesses, and those especially in urban areas did take hits to the bottom line as occupancy weakened and management was forced to grant heavy rent concessions. But even these REITs have managed to almost fully recover, and I expect investors to soon see stepped-up dividend growth. Because the best of the biggest have returned to lofty pre-pandemic valuations, the only real value in residential right now is in niches. The rest are holds for now. Regional mall operators shown in my next slide all took huge hits from the pandemic as facilities shuttered and many tenants went belly up. But the best of the biggest, like Simon Property Group, adapted and survived and have recovered much of the lost ground. Now they're losing ground again as investors worry about the impact of the next coronavirus strain. We don't see a return to 2020 lockdowns for several reasons, including the fact that so many Americans are vaccinated and or have been exposed to COVID-19 over the last 2 years. So while a slowdown is a risk, particularly if the Federal Reserve's anti-inflation measures cross the line, the best of the biggest in this group are looking attractive again. The same is true of office properties shown in my next slide. This REIT sector has easily had the most dismal performance of the 4 that depicted in price graphs. In fact, this index has generally failed to make any headway for nearly a year. As I've said, there are hot areas of office properties like life science, and best-in-class REITs that occupy unique niches appear set to remain prosperous. For example, SL Green in high-end Manhattan real estate. But the vast majority of REITs in this sector are almost certainly going to be in for some major adjustment and downsizing to reflect their tenants' desire for less space. And while that damage will only be felt over time due to staggered leasing, it's hard to see a case where unwary investors don't feel a great deal of pain, especially if they indiscriminately chase high yields. So buyer beware. The last REIT sector I want to touch on is Canada. Some of you may be asking why I would want to recommend a REIT outside the US, particularly since Canada, like most foreign countries, withholds 15% of dividends paid to US investors. And the only way you can recover that is as a credit on your US taxes. But I think there are several reasons that make it worth your while to check out the best in class of the Great White North. One is the Canadian dollar, which has historically performed well in environments of rising commodity prices and inflation, which it's hard to argue we're not in the middle of right now. I think we could easily see a return to an exchange rate near parity with the US dollar by the time the energy price cycle has run its course. And that means about a 25% boost in the US dollar value of Canadian REITs, as well as the US dollar value of any dividends they pay. Reason 2 to check them out is yields by and large are higher than most US REITs, even with the 15% withholding tax and if you make no attempt to recover it. Canadian REITs are also now raising payouts again in a way they haven't done for many years. The latest example being RioCan REIT's recent dividend boost. That's the surest sign businesses are getting stronger, even with the pandemic and government-ordered lockdowns still a threat, particularly in Canada. Weighed against that is political uncertainty that's inherent with any minority government in Ottawa. And the US dollar has been strong against other currencies since the Russian invasion of Ukraine, which has a negative impact on US investor returns from foreign stocks. But that said, the loonie, the Canadian currency, has generally held its own much better than most other currencies, and that outperformance should continue on the other end of the current crisis. The next graph shows the 3-year performance of the S&P TSX Trust Index, which before 2011 was populated by all manner of Canadian income trusts, but is now mostly REITs. And it's yet another selling point for the sector since, in contrast to the US REIT sector graphs I've shown you, the end of this graph is pointed upward despite ongoing market turmoil. Okay, so that's a look at REIT sectors, what's hot and what's not. Now let's turn to strategy. As I indicated in the REIT sheet portfolio discussion, we're basically following a 3-part strategy to pursue our approach. And that approach is, of course, to lock up best-in-class REITs when they trade at good entry points, riding them higher over time as their dividends are increased and prices follow them higher. So point 1 of the strategy is to focus on the best-in-class businesses in each sector and to sell REITs that are weakening on the inside. Point 2 is to buy only when prices make sense and otherwise be patient. That's especially important in this bull market that began in March 2009, which again is ruled by momentum, governed in large part by ETF trading, and where valuations have become a significant headwind to gains for an appreciable number of REITs. Point 3 is to take profits occasionally if a REIT's price rises significantly above the level where we're willing to invest fresh money. And that's the case for a number of REITs in the data bank, none in the portfolio at this time. This is a strategy that tends to be much more incremental than dramatic in our actions. It's also one that tends to be generally fully invested. And I want everybody to note that our model portfolio does not include a cash component. Rather, it should be used as a list of recommendations to supplement your other dividend-paying holdings. So let's take a look at what we're holding now. The next slide is an abbreviated version of the REIT sheet recommended list you'll find in the current issue of the REIT sheet. And I'll also add the data bank table in the report has extensive analysis of each company's Q4 earnings and guidance updates, so all the other numbers. And that can be found in the comments of that of the data bank. I've left out the 2 REITs on that list that REIT holds, meaning they're now well above a level I'd consider a good entry point for fresh money. I did this for space reasons primarily. The 2 of them are Avalon Bay and Mid-American Apartment. I like those REITs, but again, for space purposes, they're both holds, so I'm not showing them in this table. In the last 6 months, I've added 3 new names to our list of recommendations. Most recently, Hannon Armstrong Sustainable Infrastructure Capital, which does specialty lending to energy efficiency and renewable energy projects. Definitely a booming business now. The other 2 are grocery-anchored shopping mall owner Kimco, again a beneficiary of a very strong trend in that retail area, and financial REIT KKR Real Estate Finance Trust, which pays a big yield and is attached to a very strong private capital company, obviously. All these positions are solidly in the black since we recommended them, particularly Hannon, which it does appear we caught pretty much at the bottom, although that remains to be seen. But it looks like we got a very good price for that one, again, vindicating the strategy of waiting for good prices to get in. But right now, all 3, despite gains, are still great places to invest new capital, so very strong recommendations. Another strong recommendation is Alexandria REIT, which has moved back into a range, the price has declined, back into a range where it's particularly attractive for its growth trajectory. As a developer of the, quote, campus life science facilities, Clients include wide range of medical, big pharma. If you ever wondered where some of these great breakthroughs are developed, they're developed in these campus life science facilities. And that's what Alexandria REIT does, and they have a very bright future, I believe. Gaming and leisure properties and its 6% plus yield also appears fairly undervalued to me. I think investors are pricing in too much risk to its gaming tenants from a potential new strain of the coronavirus. So we have another opportunity to buy that one on the cheap, and that 6% yield has actually been increased pretty aggressively, as you can see in the table here, 6.2% over the last 12 months. So big yield plus growth there in an undervalued stock. And then Simon Properties, that's also come down, the big mall operator, also come down because of worries about the coronavirus to a point where it yields a very attractive 5% plus. I believe there will be another dividend boost on the way later this year as they begin ratcheting that level back up towards the pre-pandemic rate. Again, I've reviewed all these REITs in depth in the REIT sheet issue. I don't want to repeat what I've said there, but for fresh money, these 6 names, again, Hannon, Kimco, KKR, Alexandria, Gaming and Leisure, and Simon Properties, all of them present compelling value right now. And as a group, if you bought them all, they actually provide a fair measure of diversification because they're drawn from a wide range of sectors, which is also a key objective of my recommended list. I want to hold a variety of things across various sector lines. As I've said, a greatly expanded version of this table is available for viewing in the REIT sheet, and if you haven't done so already, I strongly advise checking it out for more details on these REITs, as well as the information in the data bank at the end of the report. As my next slide notes, there are now 90 names in the REIT sheet coverage universe, and I'm still very interested in adding more going forward, particularly from members' suggestions. So if you have any, please send them in. I'll be happy to check them out. Points of interest in the data bank table include risk ratings from conservative to aggressive and speculative based on designated quality criteria. As you probably surmised, I set buy, hold, sell ratings based on a combination of those, business quality criteria and valuation criteria. Generally speaking, the higher the quality of the company, the higher the price I'm willing to pay. The lower the quality of the company, the less I'm willing to pay. So please be sure to check out the REIT sheet. The current issue features, again, the full database with earnings analysis from Q4 results, also development since and guidance. In between the issue, next couple months, you will also receive updates on the macro as well as portfolio and strategy of our portfolio. So now let's get to the last piece of this briefing, which is answering your questions. I've received several since I sent the current REIT sheet issue to members, and I'd like to start by thanking everyone who contributed. REIT sheet members are also invited to our end of the month web chat to ask any questions that didn't get answered in this presentation or in the REIT sheet. So let's start with the specific REITs queried about. I don't yet cover EPR properties, but we'll add it to the list for a future REIT sheet coverage. The landlord for entertainment facilities, mainly theaters, took some hard knocks during the pandemic and in fact skipped its dividend for more than a year. But it's recently returned to dividend growth and was upgraded by Fitch to investment grade. I'm starting it out as a hold, but we'll be looking for more signs of recovery in Q1 results due out in early May. So thank you for that suggestion. I will be adding it to coverage. I mentioned innovative industrial properties a bit earlier in the presentation. They lease facilities to operators in the medical use cannabis industry, which has seen robust growth the past several years and appears set for more as more states start to legalize for medical purposes. And the REIT has rewarded investors with robust and reliable dividend growth for 5 years. I consider that proof of a viable business model, and I've started the REIT off actually as a buy at a price of 200 or lower. That's kind of an unusual practice for me. I usually start a new entry as a hold and to give it some opportunity to see what it can do. But in this case, I think this one does have a track record to make it a buy and has come off a little bit to that price. I do not cover New Lake Capital Partners, which is another cannabis industry REIT. It only went public in August of last year. The dividend yield is attractive on its face, but it does represent just 2 quarters of payments. And I believe New Lake's business model, it doesn't seem to be quite as straightforward as Innovative's. So this is one I'll watch. I may add it to coverage. Again, thanks for the suggestion, but it's kind of in a different place than Innovative at this point in terms of a proven track record. Turning to VICI Properties, it's in more or less the same business as Gaming and Leisure Properties, which I mentioned a minute ago as a recommendation. It leases facilities out to gaming and hospitality companies, including Caesars Palace in Las Vegas. I've now added to coverage as well, per the suggestion of a reader. It's a buy up to 28, though in the group I continue to prefer Gaming and Leisure for its higher yield, and the fact that it's actually probably a takeover target for VICI at some point. It's a smaller company, so again, this is an industry that's consolidating, and I think this could be a possibility. So another reason to like Gaming and Leisure. I've also picked up coverage of Office Properties Income Trust, though as a hold. The yield of almost 9% is certainly intriguing, but as my comments in the REIT Sheet databank should make clear, there are serious questions about business sustainability. And at this point, I think the best we can hope for is management finds a way to sustain the 55 cents per quarter per share dividend paid since February 2019. I have talked about preferred apartment communities earlier this briefing, specifically the high premium takeover offer it received from a unit of private capital firm Blackstone. My current advice is to sell, and here's why. Shares are pennies from the takeover price, and the extra return for holding on is just simply not worth taking the risk, which is almost infinitesimal, of deal failure. In other words, this merger falling apart, which if that happened would probably send the shares from the mid-20s where they are now to the mid-teens in fairly short order. So you're basically holding on, you're betting, you're playing for pennies when you could lose dollars. So that's pretty much a standard practice for most of the merger candidates that you'll see here that have firm offers that appreciate up to the price of the level of those offers. I generally will recommend selling those and locking in the gain rather than, again, playing for pennies, standing in the middle of the street, picking up dimes, whatever metaphor you prefer. It's just, history shows it's better to just lock those gains in. Also received a question here about how significant WP Carey, which is a recommendation, how significant its acquisition of a company called CPA-18 will be to its future dividend growth rate, which has been less than 1% annually for some time. My view is the move hastens the day when the REIT's portfolio is better positioned in the best. As I pointed out in this presentation, more than 50% of Carey's properties are now industrial, and that's a massive change from just a few years ago when it was heavily office. The need to get this transition done by WP Carey has taken precedence over literally everything else on the REIT's agenda the past couple of years. So it's not surprising they've held in more capital by holding down dividend increases. My view is we're getting to the end of the transition, though, and we'll see a faster rate of growth the next few years. Carey also appears to be set up to benefit from inflation with multiple rent escalators and locked-in finance costs. And in any case, for now, we're getting a 5% plus yield. Carries a dip on a price to 80 or lower. The direct impact of Russia's invasion of Ukraine on U.S. REITs, next question, has thankfully been very limited. That's the case with most companies focused domestically, like utilities, for example. But it appears to apply to REITs also that have substantial foreign exposure that we cover, like industrial warehouse firm Prologis. Also, Medical Properties Trust, which is on our recommended REITs list, has a number of facilities in Western Europe. Those have been basically unaffected so far by what's happened in Ukraine and the fallout from the sanctions thereafter. To the extent that the invasion and fallout from Russia's sanctions does hit the broader economy or exacerbates inflation pressures, there will be an impact on individual REITs and very likely the entire stock market. The way we're going to see where that damage is, though, will be on the individual REIT level. And at this point, there's thankfully not much to see, at least from this cause. And finally, a question on REITs and interest rates. It's an often repeated fallacy that when a stock pays dividends, it essentially becomes a bond substitute. When interest rates and bond yields fall, so goes the mantra, these stocks are supposed to rally because the relative value of their dividends against bonds rises. And when rates rise, so the story goes, the stocks are supposed to fall because of the declining value of dividends. As I said, this is a oft-repeated fallacy. Really, all that you need to do to debunk this interest rate sensitivity myth is just take a look at performance from last year. The benchmark 10-year Treasury note yield rose by 65%. That's the biggest increase in nearly a decade. So by this bonds interest rate sensitivity theory, you could have expected REITs to drop like a stone. But the iShares U.S. Real Estate ETF actually had one of its best years ever, returned more than 38%. And as I pointed out, a well-chosen portfolio of individual REITs would have done better still. We did in the REIT sheet. So pretty easy way to refute something that just gets repeated over and over and over again in the mainstream media. And good reason to basically not get your investment advice from CNBC and the like. Anyway, certainly higher interest rates are requiring businesses to adjust, so there is a real world implication of higher interest rates. But here too, it's all about the response. Again, individual REITs can benefit from inflation or be hurt by it. It really does depend on what management does, how well it controls those costs, the cost of debt being one of them. And if a company is locked in a lot of fixed rate debt, if it's able to issue green bonds, if it is if it's been controlling its refinancing needs, so it doesn't have to refinance a lot of debt at any given time, it's going to be okay. If it's and in fact, its rents and rising property values are going to more than offset anything that's going on with interest rates. If it relies on credit lines, then it's a different story. They're definitely their debt costs are going to rise and they're going to be affected by it. So again, it comes down to individual REITs. Can they benefit from inflation or be hurt by it? And it really does depend on where management what management does, how effective management is. And again, that's the kind of thing that we look at in the REIT sheet. Okay, well, that's all I have for this briefing. If you have anything else you'd like to comment on or ask about, I do invite you to attend our monthly web chat, which will be Wednesday, March 30th, starting at 2 p.m. Eastern Time, the next edition of that. It's text only, so you won't hear my voice, but my partner Elliot Gue and I will stay on until every question is answered, as we always do. I hope to hear from you there. In the meantime, thank you very much for listening to this presentation. I hope you found it helpful, and here's to your wealth.